Hi everyone. We'll be kicking off the webinar within the next 5 minutes, so stay tuned please. Thank you. Also, while we wait, can anybody who is here at the moment confirm in the questions section or chat whether they can see the presentation, the slideshow, and only the presentation slideshow? Excellent. Thank you very much, Alan, for that. Okay, great. Let's kick this webinar off. I hope everybody is having a great day this far, and I hope to make your day just a little bit greater with sharing a bit of information. This is a new topic in the Hot Forex webinar list from Blue Sky Forex. And our agenda today looks like this. First of all, I will introduce myself briefly. Then we'll look into the two types of markets that you will be trading in. We'll take a look at two different divergences that you can observe. We're going to check how to enter the trades based on the divergences that you find and how to trade them. We'll take a look at stop loss take profit levels that you can use. I'll show you a bit of a couple of examples that I picked up from the actual charts, actual price charts. And we'll be going through some dangers that you encounter in relate to trading and then divergences. And as usual, at the end, we'll have a Q&A. I'll do my best to answer to your questions. Now, before we actually get into the material, I'll quickly read out the disclaimer for you, so give me a couple of minutes. The contents of this material are provided by third party, not hot forex, and are for informational purposes only, and do not constitute investment advice. Hot forex and blue sky binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So thanks for bearing with me throughout this disclaimer. So my name is Otto. I'm a senior trader in Blue Sky Forex, which is a part of Blue Sky Binary team. We are an education and research and a trading group. Our team consists of almost 10 senior traders now, and we do provide 24-hour trade support analysis for binary options and FX, just to help them allow them to trade safer. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you to become highly profitable currency traders. Now, with that out of the way, quickly looking into the two market types that you will encounter. The first is price action, essentially a trending market. This is more powerful as it usually is driven by significant news that makes the price move. Identifying a decent trending market can be a bit more difficult than a mean reversion market because you have to understand what is actually moving the price and what is making the market trend. A mean reversion is a bit more common, it's easier to identify, and definitely can be really profitable if you know what you're doing. So on the left side of the image here, you can see the price is ranging between the closest support and resistance level. It's essentially bouncing up and down between those levels. And then you will have the trending market as the price broke out of the nearest resistance and then start to significantly trend. You'll then have a ranging market again, the price movement exhausted, and eventually faced a reversal. So you can see a significant trend forming here again after the reversal, and so on. You get the idea what is a ranging and what is a trending market. There are certain indicators that help you define the trending or ranging market a lot easier. In example, Bollinger Bands, this is a fantastic indicator that we here in the team use a lot. Some of our most effective core strategies here are based on Bollinger Band formations. So if you don't know what a Bollinger Band is, then definitely take your time to look into this and learn to use it, because it is a really, really powerful tool. Okay, so different types of divergences. They're not really two different types, but just how people tend to use them. Before I explain the two different divergences, I want to mention that one of the one that you see on the bottom here, this really isn't considered anymore. So what is divergence? It's how to consider the price and the indicator moving in a different direction or showing you an opposite information. It's really nicely illustrated on this picture here on the right. You see the price chart on the top. You see two tops forming. You have a higher high, but the indicator shows a different thing. It will have a lower high here. Also, the stochastic shows the same thing. So this is a divergence between the price and the indicator. This divergence often translates into a price reversal, although it's not always the case, and we'll get to that just a little bit later. What a divergence between the price and the indicator shows is simply an exhaustion in price momentum. So it doesn't necessarily mean that the price will definitely reverse, but it's an exhaustion in momentum, which often results as a price reversal. I'll show you a lot of examples later on, and perhaps even on the live market live chart. I picked up one of the examples a couple of hours ago from a live market, so perhaps it's interesting to see where the price actually goes, and then after maybe tomorrow you can see if the divergence really played out there as predicted. Now, the second observation method of seeing how the divergence can be observed is between two different indicators. Now, this was more observed in the past, somewhat considered. As you can see, the RSI here actually agrees with the price, although the stochastics show a different thing. Stochastics actually shows the opposite. And you see how the price still reverses. So some time ago, you could take two, or people did take two different indicators and observe the divergence between them. Of course, this does manifest in divergence with the price as well, at least one of the indicators. So if you only have stochastics on your chart and the price, you will still see a price reversal. So what we are talking about today is directly a price and an indicator divergence. Now, looking for entries when you do identify a divergence in the price and the indicator, I fetched an example that you can use with support and resistance levels. Support and resistance levels, they are a topic for another webinar if you want to get into more detail about these. One of the support resistance levels is the round numbers, which I have drawn here as well. This is 1.08000. This is a relatively strong resistance level, especially on this example here. The top line that I have drawn is a technical resistance level that I draw on the chart, and I think for this resistance level, a week or two ago, there were really it repelled the price really nicely, and then this really strong resistance level formed here as well. Now, how you can use the support resistance levels in conjunction in your trade entries? If you see the divergence forming near a significant strong support resistance levels like here, you can observe and start to time your entries. at those levels. The perfect entry obviously would be here at the top, at the peak here. Although, if you haven't identified this level, then this round number is also really close to the actual divergence, and you can start timing your entries here. Please keep in mind that without considering any crossovers, any support resistance levels, if you're not considering Bollinger Bands to help you with your entry, then it's not really smart to immediately enter the trade after you identify divergence. Otherwise, you will expose yourself to a lot of false signals, and you would be really disappointed with the results. So always take something with the divergence to actually pinpoint your entries. This is really, really important. Most likely you have heard in the previous webinars, maybe read online, that simply considering one indicator to rely your strategy on is not really the most effective way. You should always put together price action, support resistance levels, and perhaps some assisting indicators like RSI, MACD, and so on to actually pinpoint your entries. It all depends on your personality, what type of trader you are, but you can also trade completely naked and simply read the candlestick charts. That's totally fine. A lot of traders do that, and a lot of traders say that the indicators are just a gimmick. You don't really need them at all, which is true in a way. But of course, that always depends on the trader. This is actually a really significant reversal after relatively strong divergence that you can observe here. Sorry if there's a background noise. We have a construction near the office here. Okay, so looking for entries, a triangle method. This is something that I personally have developed for myself. You most likely won't find this on the internet. Based on my chart analysis and trading with the divergence, what I have observed, or simply often observed, as you can see on the picture here, first of all, you have identified the divergence. This is actually from the same picture that you have here, just a bit zoomed in. You can see the reversal happening. It's a really significant reversal. But if you zoom in to this part here, what I do is you take the difference between the previous peak and the latest peak. You multiply it by 2. Essentially, you take the distance and multiply it by 2. This would be my entry point. If I entered already here, I would expose myself to a lot of false signals, as I mentioned before. But at this point already, I would consider the reversal quite solid. And if you did enter the trade here, and if you were a scalper, so to say, you would earn some decent profits already, just earning some 20-30 pips from this drop already. Now, regarding the take profit, this can be the same length as the distance multiplied by 2. So this would be a scalper's take profit. If you are a position trader, of course, you would set a larger stop loss somewhere here, perhaps, of course, depending on your risk-reward ratio, and benefit from the whole move downwards. So it's a pretty decent move, 200 pips there. Anyways, this is just an example taken from the history chart. It's really easy always to explain what is happening on the charts in the past. It's a lot more difficult to actually use all of this information in the present. You all know that. Okay, this triangle method with the entry point multiplied by 2 of the distance, I only use this when the two peaks are not more than 30 pips away. So imagine this: if you have one peak here and the other peak, higher up, maybe 60, 70 pips, it would be stupid, to put it bluntly, to wait for a significant drop and trade here only. I mean, you can all imagine that, and it wouldn't really make sense. And for this, I still use the triangle method, but at different entry levels, which I will show you very soon as well. Now, going forward from the triangle method, you can always use moving average crossovers. You can use the MACD. You can use the stochastic crossovers to time your entry after the divergence, after the current or the latest peak that has formed. Crossovers, some like them more, some like them less. I don't use personally crossovers really much. I feel that crossovers are a relatively lagging indicator. You can always use Bollinger Bands as well. I will show you an example with the Bollinger Band and how you can utilize this along with the divergence to time your entry. As I mentioned before, Bollinger Bands is a very important ingredient in our BSB core strategies. And there are a few that we also teach here on the webinars. Of course, it's a different topic and for another webinar. Okay, now the examples. The example that I showed before, this is the triangle method. This is where my entry would be if the two peaks were less than 30 pips away from each other. You can see a significant divergence in the tops of the RSI. Of course, you can always use a different indicator. Here you can use MACD, you can use stochastics if you want. Any oscillator will work. And yeah, you can get 30, 40, 50 pip win here. On this example, my stop loss would be at the very top of this peak. So risk-reward ratio perhaps of 1:1. So you take profit here and your stop loss would be here. So definitely don't expose yourself or don't determine a very large risk-reward ratio, meaning that you would set your stop loss 2 times your take profit level. You should always aim your stop loss to be lower than your take profit. This is one of my principles that I follow very strictly. Okay, on this example in the middle here, the two peaks, sorry, perhaps it's a bit cluttered, you don't see the peak here, but if you look really closely, the very top of this candlestick is at this point, and this is more than 30 pips. This is about 60 pips if I recall correctly. In this case, there are 2 entry points that you can use. That already depends on your personal preference, depends on how you want to trade, depends on whether you scalp or whether you position trade, what is your set risk-reward ratio. You can enter the halfway through to the previous peak or at the previous peak. So this still forms a triangle. If you entered here, you would trade to the next or to the previous peak, as the blue arrow shows. The blue arrow is essentially the trades that I would make, and the yellow lines would be your stop losses. For this trade, this would be your stop loss, while still keeping the risk-reward ratio at 1:1. And if you traded from this point, then this would be your stop loss. So it's really easy to follow if you start already visualizing it. If you start perhaps using it, it will become really, really clear and really easy to use. At least for me. I'm sure you'll get a handle of it as well if you start practicing it. And here is an example of an entry that you can practice with a Bollinger Band. This is actually one of our core formations with the Bollinger Band. This is what we call a hummingbird. You can see also a significant divergence. Please note that all the divergences work in a dropping market as well. But all the examples I just picked up in a rising market. I found this first. So what you would do here, this is actually today's market. This is today's price from Euro USD. Maybe you want to, I'll open the live chart later on myself as well. Let's see where the price has already gone to. What you would do, you would actually trade at the beak here. This is not more than 30 pips. So based on the triangle method, I would only enter the trade here to confirm that the reversal is happening. But if you already add the Bollinger Bands into the equation, then trading at the peak here would be already fine because the hummingbird is a bearish formation. And you can see the convergence of the Bollinger Bands, which most likely will lead to a downward breakout later on. Usually the hummingbird formation is monitored later during the day, but just for the sake of the example, I have taken this from the recent market, just so we could actually take the time to later on check the price. So these are the few examples that I have brought out. This far, the concept of a divergence between the price and an indicator should be really clear. The price shows a different thing, higher highs, but the indicator shows a lower highs or a lower high. Now, you don't necessarily have to have 2 points. You can have, 3 or more points showing the same thing. This is even, I wouldn't personally say that's a stronger confirmation, but definitely don't ignore the divergence if it has 4 or 3 or more points or peaks, so to say. Okay, so about stop loss and take profit, I briefly touched that topic already. If we go back to the examples, here would be the stop loss for this trade. Here would be the stop loss for this trade. So as I mentioned here, that this is definitely based on your trading style. Whether you're scalping, you're day trading, position trading, etc. You would need to realize what stop loss and take profit levels to use, because it's not really there is no certain solid rule what stop loss or take profit to use. And when you are scalping or day trading, you can definitely use the triangle method and set your stop losses, take profits accordingly, as I showed you in the examples before. You can make perhaps 3-4 trades a day like this, and total 200 or more pips. Really easy, actually. When you are position trading, when you are making those longer term trades, you can easily use trailing stop or set your take profits and stop losses, based on your personal goals and targets. So again, nothing is written in stone. Okay, now how about risk reward? I also mentioned this briefly before. You should set your risk reward ratio before you actually initiate the trade, and do not modify the stop loss and take profit later on, because if you make a trade and you see the price moving against you, then there is a certain chemistry, a certain chemical reaction that start happening in your brain, which we actually explain in the webinar emotion control. You might not be able to control yourself, and or you automatically go and either remove the stop loss completely or just move it further away from the price, hoping that you're giving the price enough headroom for it to move to your direction again. If you do this, you might expose yourself to double the risk if you double the stop loss that you initially set. So the price might not do what you expect, and you get 2 times higher loss than you would originally have gotten. So definitely plan your trade before you actually trade. Set your risk-reward ratio before you make the trade. Consider your stop loss levels, and don't change them later on. Try to stick to that rule and be really, really strict. Stop meddling around with the trade after you have initiated it. Just let it run and sort of say set and forget. Okay. Right. The risk-reward ratio that you generally should aim for would be 1:1 or better, 1:2. Risk-reward ratio, the first number is risk, meaning stop loss, and the reward is the second number, meaning your take profit. Ideally, your take profit would be twice the amount of your stop loss in pips. So just an example, if your potential gain in pips is 20, meaning your take profit, then your stop loss would be 10, meaning your stop loss. Yeah, meaning your potential loss. Okay. It's definitely not recommended to wager more than 1% of your total account equity on any single trade. This is a rule that we here stick to as well. If you have a really, really large account, 100,000, maybe more, then this percent is even lower. We highly recommend the traders to trade as safe as they can. Don't overdo it. And if you face a drawdown of 5% of your account equity during a single day, simply stop trading. The market is not your friend at that day. Just stop to fight another day. Okay? If you continue, the chemical reactions in your brain already force you into the, so to say, trade spree. Perhaps you start revenge trading, and you try to, so to say, save your balance. That doesn't work. If you start revenge trading, if you already let all those emotions in, then it's so much more likely that you will make mistakes. You're not really thinking rationally. So simply stop, shut down the trading portal, and walk away. Simple as that. I know it's a lot harder to do because of all the chemistry that is already happening in your brain, but I don't know, maybe set a reminder to yourself just to check your equity each half an hour or each hour, for example. That's an option, definitely. Have something to remind you to come to your senses, so to say. Of course, easier said than done, I know. Okay, and regarding the emotion control, a topic linked to that is martingaling. I'm sure most of you have heard what a martingale is. This is essentially topping up your position, making the same trade towards the same direction, but just doubling up your position, still hoping that the price will move to your direction and hoping to either make up for the loss of the first trade. So don't martingale. It's dangerous. Most beginners have tried this and failed. Essentially, topping up, making the same mistake, and simply emptying their accounts. This is really, really risky and really, really dangerous. If you know what you're doing, of course, this can save your first trade. You can make up the money that you lost by doubling up your next position on the same asset, same direction. But the market can move against your prediction for longer than you can endure with your balance. So please try to refrain from martingale. It is really, really dangerous. An alternative to martingale would be dollar cost averaging. That is, let me bring an example. If your usual trade amount would be 1 lot, okay, then you initially don't start trading on the certain asset with 1 lots, but you will start with 0.3 lots. Let's say you sell, you go short. The price moves against you, it goes up. You initiate another trade of 0.3 lots with a better price, and once again with the 0.4 lots if the price moves again against your direction. So you're spreading out the risk. You're constantly getting a better price. Instead of 1 trade, you initiate 3 trades, for example. And obviously you would need to exit all of those trades at the same time. It's still like considered the same trade, but you're exposing, you're spreading out the risk, spreading out the exposure. So it's likely that you will win the very last trade, but you will lose the first trade just a little bit, and you will still be profiting. That is one way how to spread out the risk, but martingaling is definitely a no-go. Okay, now talking about a couple of dangers when you're trading, and that is associated with divergence as well. In general, don't trust any bots that you find on the market. Usually they are advertised, something like click here, sign up, download this, pay us money, and you will be rich. Really bluntly put. But 99% of them are scams. They are driven by affiliate marketers. They're not traders themselves. They simply know how to sweet talk you to buying their product that actually doesn't work. These expert advisors that you can attach to your charts in a MetaTrader 4 platform, very few of them actually work on a longer term basis. So try to do significant research behind a certain expert advisor if you are really confident that you want to try out one. And if you do decide to try out one, definitely do it with a demo account. Don't go running it live straight away with the actual money. It's really, really dangerous, and you will most likely, the expert advisor will most likely empty your account over some period of time. The next danger, so to say, is news. When you have identified a divergence and you're really keen on taking the opportunity, check if there are any news to be released nearby. If there is, just skip the opportunity. You'll find more opportunities later on. The news can always make prices move really unexpectedly and can put you out of the money really fast. So try to stay away from the news. If you want to trade with the news, trade the news directly. Trading the news, of course, again, is another topic for another webinar. There are some things to consider when trading news. We'll leave it at that at the moment. And related to divergence itself, now the divergence does not always translate into market reversal. As I mentioned in the beginning, a divergence tells you that the momentum is exhausting, and this doesn't definitely mean that the price will reverse or the trend will reverse. And the example at the bottom as well, you see a decent divergence showing after a long trend, but the price starts consolidating. It ranges just a few hours. I mean, not few, but several hours, and then the trend continues. And then on that example, the trend actually continued for a very long time. I just couldn't fit into the picture, otherwise the picture would be really, really small. So keep it in mind, divergence does not equal to market reversal. It equals to momentum exhaustion, which can lead to a market reversal. And quite often it does if you identify a divergence at the right time and in the right conditions. Okay, that's it for today. Please write your questions in either the chat or the questions section. I'll be more than happy to answer them. This webinar is also recorded. You can review it again later on the website. It will be uploaded at one point. So yeah, let's go for it. By the way, I forgot. Let's take a look at the live chart at the moment. I think I should have it open. Oh, nice. Okay, can you confirm if you see the MetaTrader 4? Okay, awesome. As I showed before, and I mentioned that, yeah, this is a Euro USD 1 hour chart. This is a live chart, as you can see the price moving. I took this picture earlier today. You would be able to identify a divergence here. Let me just draw the core lines here quickly from here to here. You can see the two tops forming, and you see a divergence in the RSI indicator here. And yeah, how the divergence played out beautifully. As I said in the webinar earlier as well, that most likely the price will break out after at the convergence of the Bollinger Bands. I would have entered based on the triangle formation. I would have entered here somewhere, and reaped a decent amount of pips most likely. One sec. But yeah, this is a plain breakout that we are observing here. So yeah, this one played out really nicely. Okay, so back to questions. One moment. Okay, one is asking which time frame is best to spot divergence. 1 hour time frame would be perfect. I do endure 1 hour charts. Sometimes, of course, I look at 4 hour charts. I look at daily charts just to get a broader picture of the market. But our 1 hour charts are definitely more than enough. You don't even need to go into 5-minute charts just to pinpoint your entry, which obviously you can do, but it's not really necessary if you're thinking about convergence. And I think that also answers the Salamzi question. Okay, Emeka is asking, What is happening with Euro USD? Is it fired because of the news? Is the price action because of the news, or is that how all divergences go? Emeka, no, this is not how all divergences go. This is simply just a good example how the hummingbird formation would look like, and on this occasion the divergence played out really well. I haven't been trading this week. I've been really busy with other stuff, so I haven't checked the news list. I can't confirm if the news has actually forced the price to break out there, so I will need to check it later. I can't really provide an answer to that. Okay, Alan is asking, what period do you use for the RSI? I use period of 14. That I have found to be most suitable for my trading style. Doesn't matter if I'm trading divergences, if I'm trading support resistance levels, if I'm trading BSP core formations, a period of 14 has suited me best. Of course, this all depends on one's personal preference. Some may find that period of 9 is better because it is more sensitive to the recent price movements. Some say that 24 is a good time frame, but it all depends on the personal preference. 14 is really good for me. And the levels of the RSI, Alan is asking, and the settings. Okay, well, you apply the RSI to the close price, and for the RSI there is really no other setting than the period and how the RSI is calculated. So yeah, apply it to the close price. There is really no levels you need to follow if you check divergence, just how the peaks are formed. So you don't have to see if the RSI is at 70 or 90. That already doesn't matter. What matters is are the peaks. Okay, Emaki is asking, what coordinates do you use in drawing up your Bollinger Bands? Okay, I don't manually draw Bollinger Bands. This is not done manually. There is already an official indicator inside MetaTrader 4, and I'm 100% sure that most of the larger or most of any decent chart provider gives you access to Bollinger Bands, and these are drawn onto the chart automatically based on the formula. So you don't have to manually draw them. No, just attach the Bollinger Bands onto the chart. The good settings would be to go with 20 as a period, and the deviation would be 2. These are the settings that I use. So these work out for me, and these also work out for the BSP core formations. Alan is asking what live chart we were looking at. This is a Euro USD 1 hour chart. Let me open it up again. This is the live chart. You see the price moving here at the moment. RSI, I have a really high resolution monitor. I'm not sure if you see the small numbers, but the RSI is 14. Let me just open it up. Okay, I have deleted levels that are usually drawn by default onto the RSI because these levels will only clutter the space at the moment, but these are not important. So the period is 14, and we apply it to the close price. We also have Bollinger Bands here. Bollinger Bands, let me open this up. The period is 20, and we have 2 deviations, and by default it's applied to the close price. Of course, you can play around with these, but it's not really necessary. Applying it to the close price is good enough. Okay, Onissimo is asking, when I enter the trade, how is time factored into the trade order? I'm not 100% sure I understand what you mean by the question. Can you please rephrase or just explain a bit more? Meanwhile, I will answer Alan's question. How do I set all my graphs to have RSI indicators? Okay, let me show you a quick way to do it. There is no way how you can have the MetaTrader 4 apply RSI automatically to all new charts that you open. What you can do, however, is you apply the RSI to one chart along with any indicator or any style or design you want. Then you right click on the chart, you go to template, you select save template, template name, let's put it to test, you save it. Now let's open up a new chart, let's go with GBP USD. You go right click on the chart again, you select template, and you select test. So now it has the same indicators and the same style of the template that you saved of the previous chart. This is the easiest way to do it. And perhaps if you are really new to MetaTrader 4, then after you have set up all the pairs with all the styles, all the indicators, what you can do is you go File at the top left, you go Profiles, and you save as. So you save a new profile, you go Test, you save it. So this saves the layout. This saves all your charts, okay? So now let's just test it out. Let's select another profile here. Let's go to Euro. You see it's completely different charts, different layout. And let's go back to test. You see we have the same charts open, the same layout. So whenever you set up all your charts, make sure you save the profile for future reference, because if something happens with the MetaTrader 4, you delete a chart by accident and it's really difficult to set it up again, then you already have a profile saved. I'll do that again. Okay, fine. Let's go through the easy process once more. You go right click on the chart, you go, no. You go File on the left top corner, Profiles, Save As, you enter profile name, let's go to test 2 this time, click OK. Then File on top left corner, Profiles, here is where you have all the saved profiles located, okay? So we can go back to, let's say, Swiss franc. You will have this profile here. Go File, Profiles, select Test 2. You have back your charts. Jan is asking what time period to look at. I usually use 1 hour charts. This is my go-to chart time frame for any candlestick analysis. I also check out 4 hour charts and daily charts to get a broader picture of the market. So here you can see, let's just remove the Bollinger Bands for a moment. You can see you have not significantly ranging, but a relatively ranging price here. Okay. Now, I know that I'm trading a relatively ranging market. Before I decide to initiate the trade, I switch on to 4 hour charts and daily charts just to see where the price is or where the market is at. Okay, fair enough, we have some elements of a ranging market here as well. You see we have somewhat forming resistance level here, perhaps support resistance level. Now we need to go back further to see if that level held the price back before, I can see a significant support resistance level forming here in example. And yeah, the price is close by, but not close enough for it to be any effect at the moment. So just to see the broader picture of the market, what the price is doing, you can use 4-hour and daily charts too. That's totally fine. But as my go-to chart time frame is still 1 hour. This is where I do my main analysis because I'm not a position trader. I do trade short time frames. I'm a scalper and a day trader. And this is what I do. In our team in Blue Sky Forex, different senior traders have different styles. Some of them are fundamental traders, trade based on the economic data they read and analyze. I'm really technical. I love support resistance levels. I love analyzing the candlesticks and the patterns and all the indicators that go along with it. Okay, you're asking, my opinion, where is this currency going? Has it passed its resistance? Yeah, I mean, analyzing the potential movements of the price, takes a bit longer time. It doesn't just happen like that with a nick of time. What you have to do is, of course, analyze where the price is. Right here, based on the 1 hour time frame, you see that the price has been pushed back, repelled by this level here, where it is currently at. You can see some exhaustion here. You see some heavy indecision. You can see the dojis forming here. You have doji here. Really heavy indecision. I would need to, of course, look at the news, see what is ongoing right now in the world, and then I could make an adequate decision and adequate analysis. You always have to be still self-aware what is going on in regards to news, any economic data. Even if you're not a fundamental trader, you still have to have some fundamental awareness to trade technically. Of course, news is always a part of trading. Anything going on in the world affects the price always, even if you are a technical trader, even if you rely on the candlestick analysis or indicators, you still have to be aware what is going on in the world to some degree. Okay, even if you're not completely relying on the economic data, you still have to be aware what's going on. No, these are not the only indicators that I use, Alan. Stochastics, I use Bollinger Bands, as I said before, that in our team, in our BSP core formations, a lot of the formations are simply based on Bollinger Band formations. So Bollinger Bands is an indicator that is really, really powerful that we are using. Okay, Nishant is asking, where's the best place to get news from? There are a lot of web pages that provide a news calendar. One of them is Forex Factory, I think. Any news calendar will do because they mainly have the same data available, just in different format. Just use Google, type in Forex calendar or just economic news data. You'll definitely find a lot of answers, and just pick the one that suits the style and suits the formation, and that is easy to read. Okay, we'll last call for questions. Don't hold yourself back. Okay. If no further questions at the moment, then if you receive or have any questions later on, don't hesitate to email webinars@hotforex.com. And from my side, appreciate your time today. Thanks very much for attending, and we'll see you next time. Take care, everybody.